Well, thanks for that, Abhishek. But Kotak Mahindra Bank, which has reported a weak set of second quarter numbers, their management is addressing the media as we speak. Let's take a look.
Let me first focus on the financials. At a group level this quarter, we made a profit after tax of a little over 5,000 crores. That was up 13% year on year. This has resulted in the book value of our share going to 740 rupees per share, and our overall return on equity coming in at about 13.8%. I think what the results really brought to fore was the power of being a financial conglomerate. I've talked to you before about how the Kotak plane flies on multiple engines. And this quarter, capital markets, 52% growth, asset management, 58% growth, insurance, 50% growth. All these three engines obviously had a stellar kind of quarter. In the bank, this was the first quarter where we saw the full impact of the tech embargo. But despite that, we grew customer deposits by over 16% year on year, and our CASA ratio stabilized at 43.6%, which is a very nice level of low-cost deposit ratios. However, our cost of funds, despite that, went up by 5 basis points. On the asset side, we grew by 18% year on year, led by the wholesale bank and secured advances in the consumer bank. We have seen some slowness in the rural aspects of India, and that was reflected in loans made, commercial vehicles, tractors, and of course, we've seen some stress in the microfinance industry, as well as some over-leveraging of customers, which reflects up in personal loans and credit cards. But overall in the bank, our CD ratio was at a good 86.4%. So overall, the three businesses, capital markets, asset management, insurance, had stellar quarters. The bank grew nicely, assets by 18% and deposits by 16%. Some of you would have seen that yesterday we announced the purchase of Standard Chartered's personal loan portfolio of 4,100 crores. This is very much in line with our articulated strategy about executing tuck-in portfolio acquisitions. Apart from scaling personal loan business, this also gives us 95,000 affluent customers with whom we are hoping to establish a much broader relationship. This is an important tuck-in acquisition for us, and we look to do more of such transactions going forward. Of course, on the technology front, under the guidance of the RBI, we continue to make very strong progress on the matters highlighted in the April order. We're also working very closely with our external auditor, GT Bharat, to validate the work that we have done. While all of this will greatly improve risk and resilience, we have also used this period to begin to improve the experience for our customers and colleagues through the beta launch of a new customer mobile app and automation of various customer journeys and processes. Much more to come on these matters in the coming quarters, but I'm very excited about the progress that we are making on this front. With that, let me hand it over to Devang to take us through the financial results.
Thank you, Ashok, and good afternoon, friends. Let me take you through the key highlights of the consolidated and standalone results. As Ashok mentioned, on the consolidated results, on Q2, we had a PAT of 5,044 crores, up 13%, YOY and QOQ 14%. Customer assets, which comprise of advances, including IBPC and BRDS and credit substitute at consolidated level, are at 5,10,000 crores, up 19% YOY. ROA for the quarter at the consolidated level is 2.53%. Capital adequacy at 22.6, of which CET itself is 21.7, indicating a very robust capital adequacy. Book value, as Ashok mentioned, is 740, up 22% from last year. ROE at the consolidated level is 13.88%. However, we adjust for the increase in the net worth due to the investment valuation, which does not flow to the P&L. If we adjust for that, the ROE is at 14.28%. Overall net worth of the group now just under 1,50,000 crore at 1,47,000 crore, of which bank's net worth is 1,10,000. With this, let me go to the bank standalone highlights. The bank clocked PAT of 3,344 crores for the quarter. The quarterly stood at 4.91%, which for the previous quarter was at 5.2%. Capital adequacy at bank level also high at 22.6%, with Tier 1 itself 21.5%. ROA at the bank standalone is 2.17%, which was 2.38 for the quarter one. This is excluding the gains for the KGI transaction. Due to the RBI's investment valuation circular, the reserves increased by 1,363 crores post-tax. This has not gone to P&L, and it has required by RBI regulation. This has increased the reserves and investment. This being the first quarter with the full impact of the embargo, which was applicable to the end of. Overall profit and loss impact estimated due to IT embargo is in line with the initial estimate which we have given and the earlier guidance. Core fees and services in quarter two up 14% YOY. This comes both from distribution income as well as general fees. Operating costs are stable at the same level compared to previous quarter. During the quarter, we added around 8 lakh customers, new customers to the bank. The GNPA at 30th September for the bank standalone stood at 1.49%, vis-a-vis 1.39 in the previous quarter. And net NPA at quarter is 0.43, vis-a-vis 0.35. Credit cost for the quarter two rose to 65 bips from 55 bips, and for the last quarter, the same year was 0.40 bips. SMA2 fund-based borrower with an exposure over 5 crore remains stable at 176 crores. Having done the bank standalone, let me just give you the brief outline for the subsidiary performance. At the overall group level, for the quarter, non-bank entities brought in about 33% of the overall profit of the group. The capital market subsidiaries benefited this quarter to increase in the market volumes, and that reflected in Kotak Securities performance, PAT increasing to 444 crores against 324 crores, a growth of 37%, and Kotak Capital ended the quarter profit of 90 crores, vis-a-vis 27 crores. Same. Domestic mutual fund entities contributed 197 crore for quarter two versus 124 crore same period last year. Kotak Prime closed the quarter two with a PAT of 269 crore as against 208 crore same period last year. Kotak Investment Company clocked a PAT of 141 crore against 116 crore profit same period last year. Both the NBFC, which is Kotak Prime and Kotak Investment, continue to be well capitalized with capital adequacy over 24%. BSS, the microfinance business corresponding equity, recorded a PAT of 16 crore in quarter two against 108 crore same period. Kotak Life clocked profit of 360 crores in quarter two against 247 crore in quarter two of 24, primarily due to higher gains. Kotak Life continues to maintain healthy solvency margin of 2.57% as against 1.51. With this, I hand over to Prasanna for the Q&A session.
Thank you, Deva, and thank you, Ashok. We are now ready to commence our Q&A session. As always, some notes before we commence. Questions will be taken on a first-come basis. If you have a question, please use the raise hand feature on Zoom. Once I call upon you to ask your question, please unmute yourself. Please state your name and the organization you represent before asking your question. Do remember to mute yourself once you have asked your question. We request that you keep your questions brief and to the point to allow time for as many questions as possible. And in case you encounter any technical issues during the conference, please reach out to the Kotak PR team or the Weber Shandwick team for assistance. Please note that the chat function will be disabled during the duration of the event. Our first question comes from Joel Rebello from the Economic Times. Joel?
Thank you, Prasanna. Can you hear me clearly?
Yes, we can.
Yes.
Thank you. A couple of questions. We have seen an uptick in your NPAs. If you see it quarter over quarter, there's also an uptick in the provisions because of that. If you could give us some details of where these NPAs and have come from and what's the outlook, basically. I have a follow-up question after that, if you can answer this one.
Hi, Joel. So as Ashok we mentioned in his opening remark, we are seeing some stress on the unsecured book, mainly credit card business, and which is contributing mainly to this, and we are taking.
Sorry, I couldn't hear you. Can you?
Yes, it is from the credit card, mainly from the credit card business, which is contributing to the gross NPA increase and the provision increase.
Can you give me some details as to how much is it? How much is it increase year on year or as a percentage, something?
So I think that the percentage increase is in line with the industry as well as, but I think you also need to understand, because of the embargo, our credit card book is not growing, right? It has remained stagnant, which because we are not able to add the new cards. So the percentage will be misleading, but I would say the increase is in line very much with the industry. The percentage, because the denominator is not increasing, may not be comparable.
No, what I meant was as a percentage of the slippages, total slippages during the quarter, how much is it from the credit card?
So I would say the increase in the slippage, which you see around 30 to 40% of that slippage would be from the credit cards.
Okay. So I have a follow-up then. Yes, you have explained that you all purchased the Standard Chartered personal loan portfolio because of the affluent customers that come at a time when everyone is being so risk averse and going away from unsecured, or probably, this is a very contra move. In a sense, I understand your logic of getting new customers, affluent customers, but at the current juncture, it's a little bit surprising. And what is the residual maturity in these loans? I'm assuming that you are looking at the future. So what's the residual maturity in these?
So Joel, look, the personal loan typical book is about 4 years, and then it's obviously average life 2.5 years. So you can kind of calculate that. And frankly, obviously, we would have done our due diligence properly on the portfolio. We are quite happy with the purchase. It scales up our personal loan book, as well as gives us access to the affluent customers, as you have pointed out.
And if I just add, Joel, though personal loan is also unsecured, it's very different from the card, right? So the delinquencies are, and risk-reward relation is far different in the personal loan.
Thank you.
Sorry, I couldn't hear you. Sorry, one clarification. Your NIMs have also fallen. So this trend of NIMs falling has been continuing for the last 1 year or so. What's the outlook on NIMs and what are you doing to it?
So, Joel, you can hear me now so that I don't
Yeah.
So, NIM, Joel, includes the earning assets, the yield on earning asset, and the cost of fund. So, for this quarter, the NIM has fallen by about 11 bips. The main reason for the fall in the NIM NIMs, Joel, is because as the proportion of our unsecured business into the loan reduces, which is at a higher yield, because of the environment. If you
Right.
see, it has gone down to 11.3% compared to 11.6. So that
Okay.
has an effect on the yield on the earning asset.
Okay.
And of course, this quarter, Joel, we also had IPOs. IPOs bring in short-term float money, which you
Right.
tend to deploy at a lower yield, which also
Right.
overall cools down the NIM. So these are the two reasons for the fall in the NIM for the last one.
Thank you,
Outlook?
Deva. Thanks,
Sorry,
Joel.
outlook?
We need to move on to someone else. We'll come back to you, Joel, if you can.
All the best. Thank you so much. Bye.
The next one is from Hamsini Karthik from Money Control. Hamsini.
Hi. I've been looking at your results for the last 3 quarters, from March quarter, June, and now. One of the trend, or rather 2 trends, which is very visible is that provisioning costs have been going up since, and NII growth as well as PAT growth has been significantly off the run rate that we're all used to seeing from Kotak. Is there any particular reason that you would attribute? Do you see yourself further increasing on the provisioning part of it? Because it has been increasing, whether I look at it from a sequential or on a YOY basis over the last 3 quarters. What exactly is contributing to both these trends?
The provisions will increasing, as I explained to you, mainly from the card business, as I said. But even if I look at from that, despite the provisions and all, our NIM continues to be one of the highest in the industry, and our net NPA are still at about 0.43, in fact, at this quarter. So I would not say that they are way away from the industry. But yes, you are right on terms of provisioning. It has increased due to the card business.
And this particular quarter, we're also noticing a sequential decline in the corporate banking book as well. First time I've noticed this with Kotak. Would you want to attribute it to any particular reason, ma'am?
Anthony, I will answer that question. You should actually look at the corporate banking along with credit substitutes. As you know, and we have explained this in the past, that when you look at the corporate banking business, you look at the loan book and you look at the credit substitutes too, which comprises of bonds, commercial papers. If you put both of that together, you will find that we have actually grown. Thirdly, the wholesale SME business, which is again shown separately. If you put all those 3 together, actually we've grown at 2%. So we've just given the breakup between. So we've just given the breakup between the 3 parts of the corporate, the credit substitutes, and SME business under the corporate sector. So that's how you have to look at it. But add the credit substitutes.
Yeah, Hansini, look at the page 11 of our investor.
Okay, I'll refer to that. Yeah. If I can ask one last question here. RBI came up with a draft guideline on how banks and subsidiaries of banks can, operate, and where there are overlapping businesses, only one of the entities can do it. We have Prime here handling Prime, and then there is the ARC business. There is MFI business as well in BSS, and one more subsidiary. One of the subsidiaries was subsumed into Kotak last quarter, but BSS is still outside. What sort of an implication do you believe that this particular draft norm can have, and how have you responded, or rather how do you plan to respond to this particular circular to the RBI? Do you see yourself having to let go of any of the businesses as such?
Sunny, I'll take that kind of question. Obviously, we got the order on the 4th, and obviously we are studying the order very, very, very carefully. We will, of course, go back to the RBI by November the 20th with the responses from our perspective. And obviously we will follow whatever comes out as the final kind of circular. I don't think there's any particular business we'll have to shut down. Maybe we have to do it in a slightly different entity, but I don't think there's any major impact other than that.
Thank you, Hamsini.
Thank you, Mr. Vaswani. Thank you, Prasna.
We'll move on to the next question from Ritu Singh from CNBC. Ritu?
Yeah, hi, Mr. Vaswani. First, I know you mentioned.
Ritu, are you online?
Yes.
Okay, we'll come back to Ritu later.
Yes.
We'll come back to Ritu
Yes.
later. Go ahead, Ritu.
Mr. Vaswani, first of all, we understand you said the rise in stress is largely because of what you're seeing in your credit card portfolio, but there are also lower recoveries, that we're seeing apart from the higher slippages in the quarter. If you could guide us whether you think the stress in this portfolio has peaked or whether you anticipate stress in other segments as well, and also, on the Standard Chartered acquisition of personal loans, what is the strategic significance? What is your strategy as far as the personal loans are concerned? That is a segment where a lot of banks, of course, are seeing a rise in stress. Of course, the book you're acquiring is standard, but if you could tell us, what is the strategy on that front? Would you look at more inorganic acquisitions because of the RBI embargo, which restricts you from onboarding customers digitally? And also, on deposit repricing, we recently saw you cut, the savings account rates by about 50 basis points for sub 5 lakhs. If that repricing is complete, and what that would mean in terms of whether you're going to be able to defend your margins would have been coming off.
So many questions at one go. Typical. Anyway, why don't you take the SBA kind of
So I'll just answer the first question which you said in terms of the recovery. So typically we see the recovery from especially the rural and secured book coming in quarter 3 and 4. So we are very confident that we'll be able to recover and collect money on those the NPAs in the rural and secured market during Q3 and Q4. And obviously from the card and the personal loan, the efforts are on. Obviously there are measures taken to curtail the limits and control the risk parameters. But yes, you will see recoveries coming from the secure retail book in Q3, Q4. On the other ones, I will ask Shanti to respond.
Thanks. Yeah, hi Ritu. Let me take the one on the Standard Chartered. As Ashok had said earlier, this is in line with our strategy for looking at affluent. And if you look at the personal loan portfolio of the bank, they're reasonably stable, particularly at the affluent and the asset. So this is clearly in line with a strategy of deeper penetration into the affluent segment, of course, both on secured and unsecured portfolio. This is an unsecured personal loan. We've done the due diligence on the portfolio and we're reasonably happy in terms that it is in keeping with our strategy. We will continue to look for such tuck-in inorganic opportunities if they fit within our strategy that we have. On the deposit, on the savings rate, actually, we are just aligning ourselves with the rest of the banks. And if you look at the rest of the banks and our rates, we are aligning ourselves in terms of the industry with most of the banks on the savings rate. So that's just what.
All right. Thank you.
Nayak from Reuters. Siddhi?
Hi, sir. Can you hear me?
Yes, we can.
Hi. So my first question is on the unsecured part. You said that around 30 to 40% of your overall slippages come from the credit card book. I wanted to understand if there is an outlook on when this will start to normalize. And would you also foresee the need to make more provisions in the coming quarter, especially on the credit card side?
So the credit card provisioning norms are clear. I think we anyway provide over 90 days the portfolio, the 100% provision, 180 day 100% provision. So that provision will follow as a process. And I think, as I said, that we are obviously taking measures to curtail the underwriting norms for the new book. And as we do that, we will see the improvement, especially from the new book, the delinquencies getting under control.
I just want to add one thing to Devang's point. Know that we've not been able to grow the cards portfolio since the RBI order on April 24. So this is really more of a vintage book. And Devang's already talked about the provisions. So that's where we are.
My second question is on the NIMs. You explained, why NIMs have fallen because, of the embargo, etc. Is there an internal assessment on when NIMs could start inching upwards? Any particular timeline that you have in mind?
I think, as I explained, the NIM are a function of two things: the yield on earning assets and the yield on earning assets depend on the mix of earning assets. So as we increase the mix towards a higher yielding assets, so for example, the Standard Chartered portfolio which we will purchase will have a higher NIM, or so that will have some kicker in the earning NIMs. And on the cost of fund is the second part. The cost of fund obviously will get reduced because of the saving account interest rates. So both of these measures going forward will go towards improvement in NIM. But as we see that it's also, it's also get impacted by the rate cut. It was impacted by the interest rates on the other businesses and the deposits mix. So it's a very complicated thing. But as we see today, while we continue to maintain the highest NIMs among the industry, some of the actions which we have taken in terms of the saving account rate and the portfolio acquisition will help us in at least increasing the NIM or reducing the impact of the NIM.
Thanks.
Thank you, Siddhi. We'll move on to the next question. Subhana Sheikh from NDTV Profit. Subhana.
Hi, sir. This is Subhana. I wanted to understand, you said 30 to 40% of your slippages are coming from credit card space. How much of that is coming from the MFI space, since you're clearly witnessing stress over there? And also, in your previous earnings call, you had said that you are okay with increasing your unsecured portfolio book into mid-teens, despite some some blips in your asset quality. So your asset quality has worsened a bit this quarter. So to what extent are you okay with your asset quality book increasing, your asset quality worsening in terms of with the acquisition of the unsecured personal book of Standard Chartered?
Let me just kind of clarify one thing. What Devang said was the slippages, 30-40% of that has come to the credit card book. It's not as if we are issuing credit cards to MFI customers. So this is the credit card thing. Also, look, in credit cards, what normally happens is that you go out with a certain proposition and you do some testing on the margin. Now, some of those tests work, some of those tests don't work. And these may be were tests that we did 18, 24 months ago, which are actually playing up today. So, like Shanti said, the book is kind of flat, that we're not growing it. And this kind of portfolio of the test portfolio, which is not working well, will kind of go through. Now, currently, we are unable to grow our credit card portfolio because of the embargo. But once the embargo is lifted, we will definitely come back strong. Credit cards is something that customers love, and it's a great business. And obviously, we would like to continue to do that. As far as unsecured assets is concerned, we have always said that retail unsecured assets, we would like to be in the mid-teens. We are currently a shade over 11%. And our goal of getting to the mid-teens will continue. There will be cycles, there will be ups and downs, but generally speaking, we feel pretty good about continuing to target that teens kind of number for our unsecured retail business.
Thank you, Ashok. Our next question is from Deepak Raja. Deepak. Okay, we'll move on to the next one from Anupreksha from Financial Express. Anu.
Hello. Hello, sir. Am I audible?
You are.
Yeah. Hi, sir. So I have a couple of questions. So the bank has pretty much active in loans to commercial vehicles and used car finance. So I just wanted to know if there is a significant rise in loans given to particularly in these sectors, and if yes, what is the main avenue behind that? Second, given like LCR draft guidelines are to be implemented from next financial year. So I just wanted to know like how bank is, basically going forward, they're planning to change their strategy in terms of investments in SLR and managing additional runoff factor. What are the factors they're taking care of right now? And third is, just wanted to know like out of curiosity, that what is the LCR currently? Like, what does the percentage of LCR bank as of this quarter bank has?
Please.
Yeah, hi. Let me take that question. Firstly, as far as commercial vehicles are concerned, this quarter actually at an industry saw a degrowth. And that's because of course, some climatic conditions on rains, etc. Second quarter is reasonably sluggish on the movement of goods. So that, I think, reflected as far as the growth is concerned. And if you looked at our historical growth and this quarter growth, reasonably muted because of the drop at the industry level. Otherwise, we remain committed to this business. Second question, as far as LCR is concerned, currently our LCR is at about close to 130%, which is very reasonable and robust. So even after taking into account the guidelines that are being rolled out, we will be reasonably comfortable. Because they are the regulatory guidelines, we will be complying with them, but at 130, close to 130% LCR, we are.
Thank you. We'll move on to the next question. Manojit from Business Standard. Manojit.
Yeah, hi. I just wanted to understand what is the size of the personal loan book. The PLBL consumer durables is 20,868. But what is the size of the PL book as on September 30 and what is the growth, year-on-year growth?
So we see generally, we look at all the three books together because considering the characteristics they have. So we don't segregate separately between personal loan, business loan, consumer durable. That's it. Yeah, but it's fair to say out of 20,000, more than 50% will be the personal loan book.
Okay, because that is a like-to-like comparison what you're buying from Stancy.
That is correct. That is correct. You're right.
Thank you.
Thank you.
Thanks, Manojit. Next one's from Richard Fargos from Informist. Richard.
Hi, Mr. Vaswani, you said you are making strong progress to resolve the tech issue with RBI. How much you hopeful that resolving that issue in FY25?
So, Richard, I'm obviously very hopeful, but that is frankly something not in my control. What is in my control is to continue to work very hard along with my tech team to fix all the issues. And on that, I think we've made good progress.
And so recently, of late, RBI officers at various occasions have flagged about the high rate deposit ratios. Yours is around 86%. How much comfortable with you and what was the historical ratio?
Sorry, CD ratio? Yeah. So, Richard, we actually target between 83 to 87, and we've been in that range for the most part, yes, for a long period of time.
Yes.
Okay. Thank you, Richard. Our next one's from Vishwanath Nair from NDTV Profit. Vishwanath.
Hi, this is Vishwanath Nair from NDTV Profit. Sir, you mentioned earlier that you are looking at more acquisitions. In your previous media interviews, you've also talked about being the third most profitable bank. I just wanted to get your sense as to how these two can coexist at the same time, because, irrespective of the size of the book that you acquire or the kind of business you acquire, once it's coming from outside, it takes a little while to settle down and start showing results. Do you think that profitability will be a quick turnaround for the acquisitions that you have planned so far, including the Stancy book?
Okay, let me answer that Standard Chartered book question. It's just a 4,100 crore portfolio, and it will take the next 3 months because of some of the regulatory. So that's a very small book. When you acquire a loan book, there is not much distraction in terms of ensuring that the migration stays. That's not so much. And I think as far as Ashok's statement, it was a broader statement of strategy over the next 5 years. As far as inorganic opportunities are concerned, obviously we will look at it if it's value accretive, and there is a lot of synergy as far as the bank is concerned. So as of now, the only thing that we have done is the Stancy personal loan book portfolio, which is not very in our overall asset
Thank you.
Right, sorry. Sorry, just one point on the value accretive bid. You've talked about that, and I just wanted to understand, apart from the NIM point, which you addressed a little earlier, that net interest margin will get a boost. What other profitability metrics will get a boost because of Stancy and the other acquisitions?
So, let me answer this question. So besides NIM, you have other income. So as Ashok mentioned, we are also getting a customer base of over 90,000 affluent customers. So clearly, there is significant cross-sell opportunity and fee-based income opportunity in terms of insurance, mutual fund, capital market products. So I think these are some of the opportunities which will also drive the total income besides the non-interest income.
Thank you. Our next question is from Hamsini Karthik.
Hi, this is more like a clarification that I need. Mr. Giwala mentioned in his commentary that unsecured loan book has fallen from 11.6 to 11.3%, which has caused the 11 bips fluctuation in NIM. Just want to understand, how yield heavy with this, or rather how yield contributing with this unsecured book be that, just a 30 bips fall in the construct of this book can cause such a fluctuation to NIM.
Yeah. So, let me explain. It is not just the fall of the unsecured book, but as you see, we have also grown the advances by 18%, right? So while the unsecured book is not growing, what is growing is the secured book. So if you see from the page 10, the breakup of the advances which are growing, if you see the growth is mainly happening in housing loan, LAP, SME business, which are at a lower yield. So what I meant by the yield fall is that when the mix changes towards more secured products, which are normally lower yield than the unsecured book, there is an effect on the NIM. The fall in the unsecured book is reflected in the percentage of the unsecured book, but the fall in NIM is also explained by the fall in unsecured as well as rise in the non-secured book, which are at a lower yield. That is what I meant.
Thank you.